Hi, Joe. I don't normally do this, but I'm going to take the next few minutes to try to really explain what it is that you've bought here. Because honestly, these indicators, the relative volume and the divergence indicator as well, but especially the relative volume indicators, are by far the most useful indicators that I've ever used or come up with. And they actually give you useful information. Most indicators are just, some kind of a secret oscillator or secret moving average or, whatever, all these different types of, essentially all they are is people's attempts at differentiating themselves so that they can market something, or just a lack of truly understanding the random nature of price data, and they're form-fitting all of these equations that they come up with onto the market data, which the market, couldn't care any less about. So all of that to say that price governs all of those other technical indicators. So you have price action, and then you have second order indicators or derivative indicators, which are based on price action. And it's price action that governs those indicators. But what governs price action itself? What governs that? Well, volume, obviously, but also price action governs itself, so that this may seem strange if you haven't studied market geometry or trend lines. Some of the older guys like Edwards and McGee initially talked about it, I think back in the 20s. Wyckoff talked about using trend lines and channels, and then obviously Alan Andrews talked about median lines and so on. So the whole idea behind what I'm doing, and what really you should be involved in if you're trying to make money in the markets, rather than being reactive and just waiting for X, Y, and Z to line up so that you can pull the trigger based on something happening in a moving average or an oscillator or something like that, where you're going to get those recurring patterns anyhow, X number of times, depending on the period of the look back that you're using. Those types of patterns just aren't, you're not able, yes, they are, you can find repeating patterns, but are they recurring patterns that you can profit from? Most often the answer is no, and I've tested hundreds of systems. The idea is to find patterns that you can profit from. So what I'm involved in is trying to find where these major turns in the market are going to be. So if I can consistently find these major pivots in the market, whether that be, a major high or low, or secondary high or low throughout any given day, or any larger chart, such as a 240-minute chart or an hourly chart, if I can do that consistently and then fine-tune my entry on a faster time frame, say a 2-minute chart, and limit my risk, but get the reward that I'm expecting based on the higher time frame. If I can do that consistently, I don't have to be right more than 30% of the time, but I am. Let's say I'm right 55% of the time. If I can do that consistently, find these turns, then you can make 600. I'm up 1,600 for the day today, right now. But this trade's going to go on down here, most likely. That's what I'm expecting. Expecting to break this low, put in a little bit lower low, maybe come down a little bit further, and then I'll look to try to trade long, finding the end of this move. So I'm hoping this thing will come down, make a lower low. So this is the perfect little Andrews median line where we put it in initially, we break off from it, and then we pull right back to it, and then we break lower. That's what I'm looking for. I'd like to hold this down to the median line, but that may or may not happen. So once we break this low, then I'll be looking for a good exit. But what this relative volume is doing for you, it's really incredible. It's allowing you to find these major turns in the market, and when these signals in the relative volume line up with some of the higher time frame trend channels and pitchforks, or median lines as we should call them, or some other area based on whatever you might be using. In this case, I have the pivot points here, and you can see the low right here was the CP. That's the central pivot, the midpoint of yesterday's high and low divided by 2. So that's the central pivot. That's what put in this low right here. So as I'm looking through this, and I was able to trade this high of the day, I got out early at 69 ticks, right down to the low here, and then I got out. I didn't trade it after that. That was my only trade of the day, 69 ticks. and then I've just traded again right here. But what you're able to see here, if I were to put volume on, just regular volume, you don't get any of this information. You see, yes, this is a massive amount of volume there at 912. It's an obvious pivot with the climax bar into that high. And then here we do have another very high volume bar. And that's the volume divergence pattern that I often look for. As you get further and further out, because of the seasonality of the volume on a day-to-day basis, hour-to-hour basis, when you take this out further and further and you try to do volume analysis on these larger time frames, it becomes more and more futile, really, because of the seasonality of the volume. And then you're trying to compare the volume relative to, you know, the overnight. Well, it's pointless to try to do that. But here with the relative volume, you can see this low was quite obvious, just a massive amount of relative volume, almost 1,000% coming into that low. And then when you take it out even further, then you see it on the 54-minute chart. Yes, that is the climax down into that low, almost 500% on the 54-minute. When I add volume on the 54-minute, then it gets even more ridiculous to try to do it, you know, volume analysis with normal volume. So it's not something you can use effectively. That's why a lot of people don't use volume, because it's so confusing on how to try to use it. So that's why the relative volume, and then of course the relative density. If you were to think of this in terms of electrical engineering, so just in terms of electricity, then we would relate this to the volume, the relative volume, as being the, let's say, the amperes. The amperes would be, well, let's take it to water. It would be the volume of the water, the amount of water that's flowing over time. So essentially, if you're talking about pipes, how big is the pipe? How wide is the pipe? That would be relative volume, is how much of the volume. Now, when we get into the relative density, you could relate that to voltage, which would be, the analogy would be the pressure of the pipe. So how many pounds per square inch of pressure do we have in the pipe, which is determined, the width of the pipe is determined, the volume or the amperage would be the one on top, the relative volume, and then below would be the density or the pressure or the voltage. Okay, so that's kind of the difference between the two. The one on the bottom is looking at relative volume per range, but rather than just, you know, volume per range, it's relativizing that, and it's telling you how much volume per range do we currently have relative to the average for that time period. Okay, there's a video that goes into the details about how this is actually calculated, but so that's why it's important to have both of them. You can see right here, if I were to blow this up, we have a churn bar, which is high volume per range, just normal volume divided by the range, but it's also the highest relative density of the entire European session. Okay, and that's giving us a strong indication that the market is putting in a high right here, a pivot high, a swing high, and then it turns down. So when we come down, what do we have next? Well, in the relative volume, see, we've come down to the close, yesterday's close here, and this is the ETH, electronically traded hours, the electronically traded close, so the close at 5:15 Eastern of the previous day. As we're coming down this bar, we have very high relative density. So that would be classified as a churn bar as well. Churn bar meaning that it's taking more contracts to move the market every tick further than it has been previously taking. So as we're coming into this low, the relative volume is not telling you anything. It's actually lower than the previous bar. But the relative density is saying, look, we're increasing. It's taking more contracts to move that market down every tick further. So that's why it's important to have both of these. And then finally here on the final bar, final down bar, it's a 170%, so very high, almost twice normal. And then it's a weak churn bar, so that's a very high relative volume per range, the highest of the past 10 bars. Okay, this is the highest of the past 20 bars, that's why it's yellow. This is the highest of the past 10, that's why it's orange. And then it's also even higher relative density. So really signaling to us that we are putting in a low. If that's at an area, then all the more confirmation and reason to initiate a trade. I didn't take this trade. I was just barely waking up here. connecting from this low to this low would have given us this low perfectly, right at yesterday's close. So that would be a great trade right there. And then where would we get out? Well, we have a climax bar here with a very high relative density bar as well, and that's really because we've broken this previous high. So anytime you break a previous swing high or low, you'll always have a rush of volume because you're running some stops. Okay, but then it continues up a little bit higher. Where does it get to? It gets to the pivot point. See that PP? And then it closes off of the high on even more relative volume, but less relative density. So still very high relative density though. All right, so that would be the exit for sure, right there. And then it knocks it sideways. And then it comes back down to where? Right back down to the trend line. On what? On a weak climax bar. The dark blue, or the regular blue, is the highest relative volume times the range, just a wide-ranging high volume bar, the highest of the past 10 bars. Okay, the light blue is strong climax. So this is strong climax, the blue is weak climax. But you can see it's decreasing relative density, and that's really what you want to see. There are two types of pullbacks. You'll have a pullback where at the very end of it you'll have increased relative density, signaling the low being put in, where it's taking more volume, more contracts to move the market down every tick further. So you have support coming in there, or you'll have decreasing relative density where essentially what's happening is you have a lack of supply. So as we come down more and more, we come down further, the selling just dries up. All right, then we get a kind of a quick pop where the sellers take it down immediately to the support, and then support starts to come in. You see the volume start to come in on this bar where you have an increase in relative density. It looks like less volume here, less participation. It's really because the bar is smaller, so it's moved not nearly as far as the range is a lot smaller than the previous bar, so it hasn't moved as far. But tick for tick, that's more volume per tick than the previous three. Okay, so that's why when we're coming down here, we're coming down on decreasing relative density. That's why when that ticks up off of that trend line, we want to pay attention because we're seeing support come into the market there. So that would have been another trade. And then where would you have gotten out? Well, you have a churn bar here, but that's really because we're breaking these highs. And then this climax bar, which is breaking these highs as well, still breaking the highs. And then on this bar, we've broken up above yesterday's midpoint, and then we've closed off of that low. So if I were day trading, I would probably be out right there, unless I had already defined my target as being the top of the channel, which I've drawn in this trend channel up at the top here. I didn't take this trade either. I was waiting for the high because I was expecting this to roll over. All right, so once we got up to the top of the channel, and I see this massive amount of volume come in, which is a churn bar, highest volume per range of the past 20 bars. And we've made here, as you can see, divergence. I don't need the indicator because I see it. We're going up steeply here, less steep here. We have 16 bars between the 2 points. So I'll add that divergence indicator just to show you, because this is really for people that have a hard time finding divergence or seeing it on the chart. I don't need it because, you know, it's something I just see. But let's say if we were to add, so that's 16 between them, so we would use an 8, half of the period between the two. So set this to 8, and then you'll see the divergence signal there. So you can see we have bearish divergence where the indicator, the oscillator, is making a lower high, price is making a higher high, and then the divergence signal is that arrow right there. So the dots are marking divergence potential, where we've come up now, we've made a higher high, and I'm using the closing price because that's what the indicator is using. The indicator is built on the close, so when I'm measuring the high at price, I'm using the closing price as well. Now you have the option of choosing whichever price you want, but for most oscillators you'll want to use the close. So here we pulled back and then pushed back up above this high, but on decreasing momentum. So we have divergence, the dots are signaling to us that we're making a higher high here, another higher high here, another higher high here, and then we get the confirmed divergence signal with the arrow there. Okay, so that's showing you divergence, and obviously you can bring in any indicator itself. That indicator alone is worth 400 bucks. But these indicators, you know, to put a price tag on them, I don't know why the only reason I'm selling them for 400 bucks for everything is because I haven't written all the documentation, and I'm wanting to give people a chance to actually use something to get their hands on something that's actually useful, beneficial to trading. All of these different oscillators and lines on your chart and a bunch of garbage, none of that stuff helps you in trading. The idea is to understand why the market moves the way it does, where it's going to turn, so that you can profit from some of those subsequent moves. So everything I do is anticipatory. The only time I'm reactive is if I'm going to get in after the reaction from an area. Most of the time I'll get in right when that area is touched if everything looks right. But really, every trade that I take, I've been anticipating it to occur. So I've been waiting for it to happen, and then once everything lines up, I execute. I'm not just sitting back waiting for X, Y, and Z to happen, and then I take the trade. I'm only taking the trade if I've been waiting for that area. Okay, so it's all about areas, and the volume will confirm what's happening at those areas. That's why the relative volume is so key. And so you can obviously see I'm short here, and then for this, just take the volume off, connecting from low here to low here, and then up to this high. That gives me this high perfectly, from which I took a short. You can see here the relative density has been coming up, 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 right into that high. Good looking pivot, which is obviously right at the kind of perfect look to this typical trade where you put in a pitchfork, or a median line rather, you pull off of it and then pull right back to it and then get a nice push down. So hopefully this thing will come down at least to the midpoint of this downtrend channel. And then obviously the downtrend channel, I mean, this is most of the reason why I took the short here today, which you can see we have that weak churn right at the top there. On the 6 minute we have the strong churn bar right at the top, right at that high. But what it was is on this 54 minute, connecting from this swing low here, which isn't the most obvious swing low to choose, but that's the one that I chose because that's the one that aligns perfectly with this subsequent low here. So I'm connecting from the low here to the low here. That aligns perfectly with this low, and then I bring it up to the high. The market came right up to that through the 61.8, just barely, right up to the trend line, the trend channel line perfectly. And then I see the top of the channel. It's also the 100% expansion of this trend channel, you see. And then we've made a much higher relative volume than the previous 4 bars right here. And then the next bar is even higher relative density, and it's a weak churn bar in the relative volume right there. And then obviously on the 6 minute, it's a very, very strong churn bar, as you can see right there, marked by that yellow bar. So right now I'm putting together a kind of a cheat sheet for what are these conditions and what do they mean, so that you can have just a 1 or 2 page document that will, you know, give you something to reference while you're watching this occur in real time. Okay, so once I get everything done, it's going to be much more expensive. So to have all of this now for $400, I think that's a steal compared to what everybody else sells things for. And in time, I'll have all the documentation and videos and stuff like that, and everyone who buys now will have access to all of that. So it's not something you're going to want to get rid of if you're actually interested in understanding the way the markets move and how you can profit from these moves. Most everything that I've seen is just a bunch of hocus pocus marketing garbage, just recycling stuff that other people have done years ago. They just recycle it, name it something else, and then give these really hyped up presentations. None of that stuff is really of any use as far as I can tell. These few things actually are. So with that, I'll just end it here and work on finishing that document.